Morning, everyone. Welcome to our current issues session. Today's presentation is by Phil Kinkle, looking at the impact of the new tax law as it applies to grain producers, cooperatives, etc. It's called Section 199A. It's a very new, unique position that's going to allow the producer some decent benefits when it comes to a reduction in business income, the portion that's going to be taxable. So that's going to be our presentation today. Again, as always, watching the text chat. So if you have something question that comes to mind, let us know. Raise your hand. Um, but the text chat, I'll be watching that for Phil. So have a question, please give it to us. Also, our next session will be in July, looking at probably summer crop market outlook, and we'll have another topic in addition to that. So without further ado, I'm going to turn it over to Phil, and let's get started. Thank you, Phil.
Thank you, JC. Yeah, and so we will be talking a little bit about cooperatives, and that's because for the first time on a producer's tax reform form, they're going to have a question: what percentage of your crop did you market through a cooperative? And that's going to impact their tax status. So this is kind of a tax simplification here, brought us a very complicated structure in this particular area. So we're trying to walk through this. So I think there are some producers wondering, how this is going to work, and this is a big deal. We've had meetings with cooperatives, managers, and board members trying to help them understand it from their end, and so we'll go through the pieces here. So, and out of the Tax Cuts and Jobs Act, it's always interesting. These are always Jobs Acts. They're never tax acts. It reduced the top corporate rate to 21% and eliminated this Section 199, and we call that the Domestic Production Activity Deduction, the DPAD. And actually, it was the DPAD which affected us in agriculture, but that was most of the savings to let them get to that 21%. So a lot of what happened was eliminate the DPAD and then, give that to corporations just in a lower flat rate. But they did create a new Section 199A. So we got rid of Section 199, we got 199A. And you may have seen everything that got very controversial because of the way the language was written, and whether it was intended or unintended. There was the consequence that there would be a huge advantage, or could be an advantage, to delivering to a cooperative, and they called that the grain glitch. And even the legislators that worked for it said we did not intend to create this grain glitch, and so that created a long debate of revising Section 199A. And so now we do have a revised 199A, and so then that creates kind of the opposite question of, is this impacting where I should deliver grain? And so that's a question I think that we get a lot, is should I be considering tax impacts before I decide who to deliver my grain to at this upcoming harvest? And I think my answer is going to be probably not, but we need to understand the mechanics of getting there. So again, just a brief overview of co-op taxation, but co-ops are taxed like any other corporation, but they can exclude distributions of members' profits from their taxable income. So we call those patronage refunds. And so basically and then the cooperative member includes those profits in their income. And so that creates a pass-through taxation. And the reason it's a pass-through is if you distribute all your income, you have no income left at the bottom line to be taxed just like any other corporation. So they get to that pass-through taxation a different way, but they can achieve that. And that's been the basic concept of the cooperative taxation under subchapter T. Is this co-op is an extension of the farm firm, and so therefore the farmer is receiving the benefits and paying the taxes on those. But because of that, of course, there's not a lot of benefit from the reduction in the corporate rate from the cooperative, because they didn't have a lot of taxes at the corporate rate. And so that created the argument for retaining or creating a new Section 199A for cooperatives. And there was also simultaneously kind of a provision there for pass-through entities with kind of the same concept. These are entities that are not taxed at the corporate rate, and so they're not benefiting from the corporate tax. And so that's where we got this argument from to create a Section 199A for cooperatives and to some extent to pass-through entities. So the old Section 199A, the DPAD, that came out of the American Jobs Creation Act of 2004, another tax act that we call the Jobs Act. And it was for domestic manufacturing firms. And so the concept was at one point, there was tax credits for somebody that exported. And they're saying, well, instead of just doing it for firms that export, we ought to be doing tax credits for firms that are manufacturing in the United States. And then they finally extended that and said, well, farmers are actually manufacturing something. So farmers would be a manufacturing firm. And then we extended that even to cooperatives to say that the cooperative could be manufacturing collectively on the part of its farmers. So it came in under first at a small amount, but it got to be up to 9% of the qualified production activities income, pretty much 9% of income, or 50% of W-2 wages that were associated with that domestic manufacturing. And so you could see the logic there. We want to give this to American people that are producing domestically, but also that are hiring people. So if you're not hiring people domestically, you don't get this. And so then the cooperative could take this deduction on the behalf of its members, and it could retain this deduction or pass some of it through. And so that was a big argument in justifying the Section 199A also was cooperatives have been getting this deduction and they've been passing it on to their members, and so this has been a big tax deduction that's going to our hardworking farmers, and we don't want to take that away out of this tax reform. So this, you can see in the final structure, this kind of gives us some insight of where our final structure maybe came from. So this was the old domestic manufacturing, and again, it had these two calculations at the income and W-2 wages. So marketing co-ops could structure their commodity payments so that they were collectively producing those commodities and just pooling them. And that meant that the payments that they made to their producers were an advance on their final pool, but we're not purchasing the co-ops. And I'll show you later when we get to some example numbers. This made a huge difference in the amount of qualified income. So if you didn't do this, then it would just basically be the patronage. It would be the net income of the co-op, and you get 9% of that, and that'd be a small number. Now it would be that number plus all the value of the grain, because that's never been taken off of cost of goods sold. So now it's a much bigger number. And so they, what we call that is they recharacterize their commodity payments as per pence, per unit retained paid in money. And those are not considered cost of goods sold. And if you want to think of where they came out, like if you go to California, like the fig co-op, there is no market for figs. And so they just take all those figs and, I don't know, make fig Newtons or whatever they do with them, eventually, process them, sell them, and then eventually they close the pool and distribute all the money. And in the meantime, when you're delivering figs or at other times, they give you some kind of intermittent payment. And so that was where it would be called a per pen. And you can see it certainly makes sense in those pooling cooperatives because there is no transaction. And then they realized that actually, though, any co-op, including a wheat or a grain co-op, could decide that they want to be making that payment as a per pen, even if it was related in magnitude to the value of the grain. They're not saying that they're purchasing the grain, they're just giving you an advance payment. And so that's where we got this structure of per pence. And because this was based on this 9% of income or half of the W-2 wages, almost always the co-op had much more W-2 wages than the farmer did. And so rather than leave all this deduction back with the farmers, and the farmers could take it, it made more sense for the co-op to do it. And that's this W-2 wages on the old DPAD was only done once. And so once the co-op did that, then they could actually distribute DPAD onto their members, and so some members were actually getting more DPAD passed through from the co-op, even if it was only part of it, than they would have gotten if the co-op had chosen not to do it and they tried to take it all on their own level. So complicated, but that's the old DPAD, and really came out of this concept that farmers are manufacturing, and so they got this manufacturing credit. And if you think across the United States, obviously there's lots and lots and lots of manufacturing firms, and so that's why this was a big target on tax reform, of do away with the DPAD to get money for tax to lower the corporate tax rate. So what we got after we revised is Section 199A. So the first part is that all producers except people farming as C corporations get a 20% pass-through entity deduction from their qualified income. So basically that's their their farm income associated with crops, the things they're manufacturing. And so that kind of is the concept that those entities were not getting any benefit from the corporate tax rate change, and so this is where they got a benefit as this deduction for a pass-through entity. Marketing cooperatives were given a deduction at the cooperative level, which they could keep or pass on, and so one of the things they said, we just want our old DPAD back, and so this was in some way some of that structure. But then they also said that farmers that are marketing through cooperatives have an offset in there, or a potential offset in their 20% pass-through. And then the offset is based on farm level calculations, and so it's not linked to the pass-through from the cooperative. So if you indicate that you marketed through a cooperative, you could get your 20% offset reduced, and that's totally separate from any pass-through that the cooperative gave you. So as you can see, that's where some of the complication of this comes. So there's a pass-through at the deduction at the co-op level that they can keep some or all of, or pass through, and then the all farmers have this 20% deduction, but if you market through a cooperative, you can have that offset. So the cooperative level deduction is basically 9% of their income less all their cost of goods sold and expenses. And so you could see, particularly for a grain cooperative, 9% of income less all expenses is probably, that would just be your profit for the co-op. But if you bought the grain as a per pen, then that's basically 9% of all of the commodity payments, plus your profits. And that's capped at 50% of the W-2 wages for the cooperative, and they can retain or pass that on. And so we'll show you it's almost always this W-2 level that's effective at the cooperative. So that's the co-op deduction. And then again, just like the old DPAD, co-ops are going to have to characterize their commodity payments as per pens to really get much of a significant 199A deduction. And so a lot of co-ops have done that already, but some have never gone to that structure. And so I'll touch on that later, but that's they're probably going to need to. So now at the producer level, any producer that's doing business in anything other than a C corporation, they get a deduction of 20% of their net income from commodity sales, not exceeding their taxable income, and it phases out, $157,000 for a single flower. I think very jointly it's $300,000 or $400,000. So at high income, it does start to phase out, but for most it's 20%. And then if they market through a cooperative, they get this possible offset, and again, this offset is not linked to any deduction that they actually pass through. So I don't know what the rationale was. It certainly would have been a lot simpler if they had just made this offset equal to what they passed through. And so therefore that would prevent anybody from double dipping. Possibly what they were trying to do is make sure that the co-ops did actually pass some of this through. But anyway, we get this structure that every producer gets a 20% reduction, but if you market through a cooperative, that could be offset. So the offset is the lesser of 9% of their income from commodity sales. That would basically be their commodity income plus any patronage they got from the co-op, or 50% of the W-2 wages. So that has a very similar structure to the calculation at the co-op level, but it's calculated on two entirely different bases. So very few co-ops could actually pass through 9% of their income, because their W-2 wages is going to be half of their W-2 wages is less than that. But if they did, there's no reason to believe that 9% of the producer's share of 9% of the co-op's income is going to equal 9% of the producer's income. The same way, if the co-op was limited by half of their W-2 wages and they pass that on to the producer, there's nothing to make us believe that your pass-through based on half of the co-op's W-2 wages is going to equal to half of your W-2 wages. So it sounds like they were creating just a similar offset on the co-op, on the producer side, to offset what they got from the cooperative, but there's really no link between the two. So a key point here is that a producer with no W-2 wages has no offset. If you have high W-2 wages, theoretically, you could get the full 9% offset, and so your 20% reduction could come down to as low as 11%. So that's kind of the worst case scenario. So there's an awful lot of people that ask about this that probably have no W-2 wages, and so there is a real simple answer for them, is that this offset doesn't matter. You won't have any offset, so it doesn't matter who you deliver commodities to. You won't have an effective offset. So that's the key point there, that the producer's offset is limited to W-2 wages. So now, for the first time, we have a W-2 wage calculation on both sides, on the producer side and on the co-op side. So the question that comes up, should this impact who I deliver grain to? So if you're delivering to an independent firm, you just get 20% deduction as a pass-through entity, and you're not going to have any offset through that, and you're also not going to have any Section 199A pass through from your grain firm or any profit distribution. So you've got your 20% deduction linked in, but no other upside. If you deliver through the cooperative, you do face this potential offset in your 20% deduction, but you also have the potential for a pass through from the cooperative, and also, of course, patronage from the cooperative. So when you get this question, does it matter, am I have an advantage or disadvantage of delivering grain to one or the other type of firms? It depends on those balance of those two factors. What are you getting from the cooperative, and what is your offset? So I wish this was a simpler question. So I've seen, at least I think, a lot of bad information out there. You hear a lot of times, well, large producers need to deliver to independents. Well, it really has to do with the ratio of your W-2 wages to your farm income. So it's really not much to do with the size of operation. Some people say, well, the producer's deduction range from 11% to 29%. Well, the 11% could be true. I mean, the very worst case is that you get it reduced the full 9%. But the 29% is really not true, because, again, even the full 9% for the cooperative, there's no telling how that relates on to a percentage of the producer's income. So, even though this is the function, these numbers being calculated on different bases, and so it's not as simple as saying that even we've got it bracketed between 11% and some unknown upside. And then even the Joint Tax Committee sent out an example, and the National Council of Farmer Cooperatives spread that around. And so it was an example of a co-op that had almost no W-2 wages and a farm with really high W-2 wages. And so they showed some of the possibilities. And so the mathematics was correct, but it was highly unlikely, because I just haven't seen cooperatives that didn't have any employees. And so, when you had that structure, the co-op had almost no Section 199A that they could pass through. And then the farmer was faced with the full offset because they had very high W-2 wages. And so a lot of the examples you see out there are kind of based on, well, let's show a whole range of outcomes without really looking at too much of, is this outcome very reasonable? And so, they're not fake news, they're not incorrect, but they're not very representative. So that's what I set out to do, was could we come up with a representative, a realistic comparison? So I used the most recent data from 2016 from Ag Co-op Service, and got all the sales margins, like local savings, profit, labor expense for a cooperative, and I could calculate all the potential Section 198 deduction for a representative grain marketing cooperative. On the same way, I took the ERS statistics, and they had the cost of grain production by region. And so I did the same calculations for a representative Southern Plains grain farm. So I used those two things then to try to see how this would work with a representative co-op and a representative producer. So here's the cooperative, and so their labor comes out about 15 cents a bushel. And so again, half of that's going to be my 7.3 cents. Their profit's about 8 cents a bushel, and 9% of their income is 33 cents. And so if you can, this is where we get back to that per pen. If you calculate back there, that means that all of their qualified income was about 350 a bushel. So you can see 350 a bushel, to take 9% of that. Anyway, 33 cents is a whole lot more than 7 cents, and so that's why it's so important that they have to do it as a per pen. Because they didn't do it a per pen, their potential pass-through would be 9% of that 8 cents of profit savings. And so it'd be very small, less than a penny a bushel. And so it's much larger because they're not subtracting the commodity payment. But again, I think the key point is it's almost always true that it's going to be half of the W-2 wages. And so the binding constraint is the W-2 wages. And so they've got a Section 198 deduction at the co-op level of 7.3 cents. And so just to use some numbers here, I'm going to say they pass through 75% of that to the producer. And then on average, the typical grain representative co-op has 3.6 cents of patronage that they pass on to the producer. So they had 7.9 cents of savings, and so they're passing half of that on in roughly half of that on in cash patronage. So that's what the producer gets. Okay, so if you look at the grain farmer side, 9% of their income is about 32 cents a bushel, but half of their W-2 wages is 6 cents. Now that 32 cents a bushel, that might be high. It's a little hard to know how to take out all the qualified expenses. So I put in all of their receipts from the grain farming plus their patronage from the co-op. I didn't adjust that for the operating expenses. So possibly that's too high, but in any case, clearly the binding constraint on the grain farm, or the representative grain farm, is going to be half of the W-2 wages. So on both sides, the W-2 wages is really what's driving that. And so they could have an offset of 6 cents a bushel, which is half of their W-2 wages. So if they told IRS, I mark it to the cooperative, they immediately get a 6 cent a bushel reduction in their 20% deduction. Their pass-through entity deduction. So here, in this case, the cooperative is giving them that 75% pass-through back. They're also getting them cash patronage. So pretty much at this 75% level, it's a wash as far as tax deduction, and so I have made this come out so that they gain 3 cents a bushel, just a little bit less than their patronage. So you can see with representative numbers, it's all driven by the half of the W-2 wages, and a typical co-op could pass on a good portion, but a portion of their pass-through, and have enough to offset, to make the producer whole, offset their offset, I guess is what you'd say, or make up for their offset, and so they would have the same 20% deduction as someone that delivered to an independent farm. So again, a little feel, and I think the other piece here is that you can see that we're working with a few cents a bushel here. We're not working with massive numbers, and so I guess that's probably another important point. So what does that mean to if you deliver to a cooperative? Well, the cooperative is going to need to pass through about 3/4 of their deduction to keep you equivalent. If you, and that's not thinking about the patronage, if you consider the patronage is only about 40%, so the co-op could pass on 40%, and then after patronage you'd be level. And then, of course, if you don't have any W-2 wages, then or had less W-2 wages, you would be equivalent to even lower pass-through. And if you had higher W-2 wages, it might take more. So if you had no W-2 wages, then any pass-through you get from the cooperative is gravy. And of course, if you get high W-2 wages, it might take more than that 75%, possibly even more than all that they could give you. So, you know, it is going to vary with every producer with W-2 wages. So we started wondering then, what are the W-2 wages on? And so you might notice, remember I said it was about 3%. So you can see on that graph, there's almost nobody really at the 3% level. About 20% of the grain producers do have enough W-2 wages to make the 9% the binding offset and not the W-2 wages. But if you see that there's really nobody, and also nobody's really at that typical level. Most producers, the vast majority, have almost zero, and then there are a few producers with high W-2 wages. So that's one of the pieces here. I think as we talk about this, again, I think the majority of the people we talk to are not going to have enough W-2 wages that this is really an issue. And so that's a real quick answer that we've got out there. If you don't have W-2 wages, don't even worry about this. And then whatever you get from the with the co-op gives you an offset, that's great. And of course, but it's not really going to affect your deduction. So that's one piece. So we looked at then who was in those high wages, and so they tended to have $4 million in assets on average. This is those people that did have enough W-2 wages. They sold over $1 million of commodities. 11% of all these farms were organized as C corps, and so again, I said about 20% here of the farms. This is also out of the Kansas Farm Records Management Database. About 20% have had enough W-2 wages, but more than half of those were organized as C corps, and so it's hard to say. I think you might notice that there's a whole bunch up here that have 100% of their farm income as W-2 wages. That may be the C corps that have structured that as a way to get the income back out of the C corp to the owners. And so if you think of that that part of the graph as not being relevant, because since they're not a pass-through entity, they don't get that deduction anyway. So we're left with only a portion here of high W-2 wage producers, and it does look like they do tend to be big farmers. So you know, that certainly is a point. If somebody's got a lot of W-2 wages, then this is a more complicated decision. So what have I've been telling, so again, we've had regional meetings with this with cooperative managers and boards. So the cooperative is going to need to pass through a portion, probably a good portion, to their patrons to eliminate the tax penalties for marketing through a co-op. So that's one piece. You know, before it was kind of this is a tax benefit, and on average we got a lot more of the co-op taking it and deciding that they want to pass some along. So we had a whole range of co-ops that kept it and passed it through and everything in between. So we're going to have much more pressure for the co-ops to be passing this on. There are some co-ops out there that didn't take advantage of DPAD, and if you can think of this whole structure of having to now buy commodities as per pins and give a different notice to their customers. So some cooperatives said, look, this has all been the farmer's tax credit all the way along. I don't think we need to get involved in this in the co-op level. Well, now those co-ops really need to scramble, because they're producers are going to be penalized whether or not their co-op can give them a pass-through. So the co-op almost can't afford not to take the pass-through, take the deduction at the co-op level now, just to be in the position to be able to pass some of it through to offset their producer side. So one of the complications out of our tax simplification is we do have some co-ops now that are really going to have to struggle and figure out how are they going to get set up to do everything on per pins and understand this Section 199A if they haven't done that previously. The Section 199A deduction is not really any different than this concept of cash patronage. You know, you took your grain to a co-op, or you could have taken it to an independent, and when you take the grain, you have no idea whether there's going to be any profits, whether you're going to get any profit distribution, and so you make that decision, taking that risk going forward. And of course, the board of directors of the co-op is making a balancing act of, can we afford to give this cash back to the members? How much do we need at the co-op level? So we've expanded now that uncertainty, and that balancing act is be not only the cash patronage but the cash deduction. So when someone delivers to a co-op, they will not yet know either their patronage or their pass-through that they're going to get at the end of the season, long after the grain is delivered. So it adds to that structure, but it's not really fundamentally different, and it's part of, I say that's a part of being an owner of the firm. When you're an owner of something, you get the residual impacts, but there certainly now is going to be both a tax reform, tax credit impact, and of course the profit impact. So the question then that most, I think probably most important to answer, what does it mean for a grain producer? Someone comes in my office and says, should I be considering these tax effects as I think about delivering grain? So the first piece is, if you don't have W-2 wages, it makes no difference. You're not going to have any offset to their 20% deduction. So there's no downside. The other point is that this 20% deduction is based on 20% of your qualified income, and we could go into exactly what that's described at, but it's capped at your taxable income. And so there's a lot of producers seem to be able to manage things that they don't have a lot of taxable income, even if they started out with quite a bit of revenue. So again, they may not even need their total 20% deduction to erase their taxable income. And so if they don't think they're going to have a lot of taxable income, then this is another also reason not to worry about it. So if you kind of look at this year with the freeze and the drought and everything else, it doesn't seem, at least for grain producers, that this may be going to be the banner year. And so maybe this is not a year we're going to have a lot of taxable income problems. And so again, maybe that's a reason that this is not a huge concern. Obviously the co-op boards have all been looking at this. They know that they're going to have to pass through a portion of this. And so, my prediction is that, of course, they can't do this perfect for every producer. It does benefit. Some producers are going to get a windfall because they have no W-2 wages, and so they're getting a pass-through from the co-op, even though they had no offset. But I would imagine that the co-op boards are going to try to hit the happy median and pass through an appropriate amount. And so I think the best advice that I have is that just continue to do business with the agribusinesses that provide you with the best service and value package. And as we often say, don't manage things just for tax effects. But I think for most producers, this tax effect is not going to be a major consideration. I'm also thinking that after we go through, 1 year of this and everybody sees how it comes out, I don't think it'll be a huge issue going forward. I think people will be comfortable for it. Obviously, from my perspective, a great agribusiness that has a great value package would be the one that the producer owns and gets profit from. But, I think on a broader perspective is, if someone says, should I change who I'm delivering grain through? I would say no. If you've got good reasons that that's the best place for you to deliver grain to get service and value and logistics, and they're in the right place with the right price, I wouldn't really worry about this tax effect as who I market grain through. So that's again the basic pieces of this Section 199A. It is complex because there's a calculation at the co-op level which gets a deduction which can be kept or passed on. and then there's an offset at the producer level, which is not linked. Both of those, probably the W-2 wages, are the binding part of that. If you look at it for a typical co-op and a typical producer, it looks to me like the co-op's going to be able to pass through a portion of theirs, and they'll offset what the typical producer at least would need on their end. If you've got someone that's got very, very high W-2 wages, and then of course if they're high income, then their 20% deduction is phasing out anyway, and so those people need to go talk to tax specialists and get into this deeper. But I think a simple question for an awful lot of producers is, if you don't have W-2 wages, not going to be a big issue. Even for the average producer, probably this is not going to be a huge issue, because the pass-through they get from the cooperative is likely to be about what they need. So with that, Jesse, I don't see any questions in the chat box. Have you got any comments or observations? Anything else I need to expand on here?
You covered it well. The only real questions will be, and we'll be putting more of this together, but right now the rules and regulations from IRS hasn't come out, and when they are, when those become proven, we may have some additional clarification that will help both farmers and the cooperatives understand all the provisions of the 199A rules as they apply to the pass-through entities. And when that does happen, I plan on getting back and readdressing this issue so that we'll have a better idea of what's going on and what to expect.
Yeah, absolutely. The devil is going to be in the details, and there's even a lot of questions, what line and where is this going to show up on what form, and so there's a lot of unanswered questions. I think the most critical question coming up is, should this have any impact on grain harvest? And so that was the purpose of this analysis and this fact sheet. And so again, here I've got a link. We do have a fact sheet out on this that goes through all these calculations, and so if that's helpful for you. But I think the first line of the fact sheet says, a lot of people are asking, should I be concerned about that? And the short answer is probably not, but explaining that is a little complex. And so hopefully you've had a little insight into this complex explanation for that simple point of for most producers, at least, it's probably not a
another thing that Phil and I will be doing. We'll be sending the link to this thing, recorded presentation, to everyone that we have on our list. If you know of others that have a use for or need for this type of material, share that link with them. They can find it on the Ag Econ website, our extension website, and they can look at all the presentations that we have made over the past several months. So it's should be quite helpful. And I noticed Sean over the right-hand side actually looks like put the link there as well. So hopefully all of those, and I believe his link is active, so if you hit it, you should be able to access that link right now. Seeing nothing else being typed into the chat box, I'd like to thank everybody for attending. Phil, I greatly appreciate you taking the time to put this together. Be prepared to, again, address this same scenario when we finally get some clarification from IRS and the Treasury. We'll be doing another one of these sessions. Our next scheduled session is in July. If there's something that pops up between now and then, we will address that, because we're finding out that we have a lot of things that are popping up on a fairly regular basis that need to be addressed. So we've been doing these more than just our regular every other month. So without further ado, thank you for attending. This will be posted to the website. If you know of anybody that needs it, send them there. We will send everybody a link to that so they can see it as well and review it if they need to. And the slides and the link to the PowerPoint will also be on that website.
And JC, thanks for the opportunity. And if you've got any producers that have got any question, I'd be glad to visit with them on the phone.
So again, thank you for attending. We will catch you next time.